Good evening. Hi, this is Stan Moore. We're going to do more hedging and parlaying. We're going to do a little more multiple time frame trading. And I'm going to start with the daily chart. And what I'm going to show is we've had one of the great runs from last October. I don't show it all the way back, but you can see the market's making higher highs and higher lows all the way through. The oscillators trade between 44 and jammed. Okay, and here we get a little triple divergence right at the absolute top. The market corrects down to a big 40, goes back up, and guess what? We do not make from a shallow. We do not make a higher high. Now we know from the original manual in the Bible, we know when we have a retest failure, it defines the end of a move. And the end of the move is defined by we're going to take out this low. Okay, so we don't make a higher high. The up is over. See, only overbought from jammed. Okay, we're now going to take out the intervening low. Guess what? We do. Okay, so here we are set up. We're failing underneath the 50-day moving average. Anytime you get under the 50, you basically want to be selling rallies. We're under the 20, which is the brown line, and here's the 100. We got massive support in here. Okay, we're at the biggest 40 going back to December 19th. That's the last big bottom, and then there are a couple more behind that. So the big 40 will be down in here somewhere. It'll get down to probably between 80 and 1300. So we have, I think, supports in here. I said 1300. I think it could be a little lower. But anyway, we want to sell rallies, okay? So right now we're failing underneath the 50, underneath the 20, and we're holding the 100-day at a big 40. That's why I told you 40 is the big fascination number. 38 and change, it's really a little lower. It really goes down to about 35, let's say. Okay, so here we are. We're testing Friday morning. We're testing the 100-day moving average. I'll show you on the 30-minute chart what I'm talking about. See, the 100-day moving average is rising. It's support. You can see the market has been going through a consolidation period. You see all these quintuple tops. Okay, we don't often see 5 tops without going higher, but in this case, because Greece is uncertain, they don't even have leadership, and they think that everybody's telling you they're going to leave the euro and all hell's going to break loose. So the market's a sale. Just keep selling the ups. Okay, but meanwhile, here's your 100-day average here, holds. Here's your 100-day average here, holds. Still playing the calls, still recommending the calls. Send an email alert out Friday morning. You know, I didn't think the 36s were the place to be. I recommended the 35s, okay? And I'll go through it on the 5-minute chart. And then guess what? We go up and make a marginal high, but we only get overbought. So we want to sell these. We want to buy the dips. We want to sell the rips. And look at this. This is one of the great 9 trades in a row where the market just trends down, holds trend line. It's phenomenal. But anyway, I want to show you where we're recommending in the morning before the market opens, recommending the calls. Okay, and we're going to hedge. Now, this is very difficult to hedge powerful bars like this. But once you start getting up in here, you start seeing the bars get smaller, and you start getting setups for calls, and we drop down to the 5-minute chart. So I'm now going to the 5-minute chart. Okay, here it is. I recommended the hold the 136s. We owned those about 50 cents. They open around 10. I thought they wouldn't be the option to trade. And in hindsight, they turned out to be the great throwaway trade I talk about, where you buy an option out of the money for 10 cents, doesn't matter. You don't sell it because the market's at a massive buy level. You don't sell it at 10 cents. What you do is you either average in or you buy the one lower, which in this case was 50 cents, 49 cents, 50 cents. Okay, to 135s. See, I'd rather own something at the money for 50 cents than something out of the money for a dime. But I'm holding these. I'm not selling them. Okay, so I buy some of these. The market rips up. Okay, now what happens is we get great news with the consumer confidence indicator, confidence number. It blows out, best in 3 years. See, this is what's happening. The market is getting trapped between the ugly news overseas and the good news domestically. And we're turning out to be the only safe haven or the best house in a shitty neighborhood. So people are flying into our dollar. Dollar's up 9 days in a row. The euro's getting smashed. Talk of Greece leaving the euro land, and that's going to be very negative for markets in general. But meanwhile, the bonds are going through the roof. The dollar's going through the roof. People are putting money in our markets, and that's why the market's not falling apart. And the fundamentals are okay. So we have a market that's trapped between, let's say, 1335 and let's make it easy, 1415. We got a market, and the lower it goes, the more attractive our stocks become. And the higher it goes, the more you want to sell it because of the outside risk out there. Anyway, the market opens up at the 100-day moving average and roughly retested 5.9, 80% of the lower low I showed you on the 30-minute chart. So basically, we're looking to buy the options. The market holds, the market's oversold. We want to buy, and then we start hedging in here. Okay? We don't make a lot of money. It's good when you don't make a lot of money hedging. Okay, the AD start out 1 to 2. Okay, basically that says, we want to sell rally still. Not sure. And then the consumer confidence number comes out, blows out, takes out the opening highs. Okay, now we have support, we have a breakout. Okay, we don't have an orbital, we don't have an opening range breakout because we don't have 2 reference points. This just breaks out through the high. Okay, now if we had a high here, pull back, had a high here, then this would be an orbital, opening range breakout, we'd have a great trade. The market blows out. See, the ADs don't support the breakout yet. Maybe we can go higher. We have a quintuple top on it, and I showed you on the 30-minute chart. Quintuple top, it's not likely that, it goes up or down, but, because the market's locked in a range bound by the news I told you. The ADs are flat. Okay, we're 2 to 1, they're now flat. The market's making higher highs, slightly higher highs. The oscillator is barely getting overbought, jammed. Okay, we want to start. So I put out on the charts, I'm starting to sell the options. Shit, you buy them at 50 cents, they're at $1.60, then we got to sell some. Okay, they're going to scale out. I want to get out. I'm scaling out. Okay, unfortunately, the market dies. I don't get out of the rest of them. But meanwhile, the options that were 10 cents and I talked about a throwaway trade are trading 90 cents. I mean, my God, can you imagine if you bought 200 up for $2,000? Also, you got $18,000. This is what makes this game so much fun. And you paid for them. The first hedge paid for them. This hedge, you made a little money. You paid for them probably because this is about 3 points. So let's say you went long 100 options at 10 cents, $1,000. You sell 30 S&Ps, you make 3 points, that's $1,500. You're up $500 on the first trade. So you got free calls. And then when you go to 90 cents, you're gone. Or hedge again, you pick up another $150 here. I mean, it's incredible returns. Again, nothing here. So you short here. Now you start making money. Okay? So what happens is we're getting up into this rarefied atmosphere, getting to the top of the range. We're getting up to that 1358, 1360. Really tough. Really, really tough to get through that slog up there. You saw the bigger charts. Okay? And we failed to make a higher high. So you're in the midst, when you fail to make a higher high, you're going down and correcting, and as I pointed out, you're going to start taking out lows. So we know we want to sell rallies. That's the reason we're buying calls. Okay? Normally, what happens when you buy calls and the market goes down, the calls go down, you hedge, you pay for them, and you're buying more calls going down cheaper. So you start out buying them 50 cents, you end up buying them at 20 cents. And then the market rallies, and all of a sudden you make a hell of a lot of money, or the market continues lower and you're shorting 3 and 4 times the number of S&Ps you started with. Okay, so you buy, let's say 20 options at 50 cents, 50 options, whatever your capital allow, and all of a sudden the thing goes down, you start buying a lot of them, all of a sudden you start hedging 100, 200 S&Ps, or spiders, whatever it puts you, 25% margin on the spiders, you can short a lot of S&Ps, depending on the size of your account. So you can make a lot of money when you're right about the market going down, your long calls, because you're scaling at regular prices. If you buy the puts, and the puts are going up in value, but you can't buy anymore, because all of a sudden you're buying them at 50 cents and now $1. You don't want to add to them at $1 because it's too hard to make the money. You got to make bigger moves. You got to make 2 or 3 trades to pay for a $1 option, where you make a half a trade and you pay for the 10 cent, 20 cent options. That's the beauty of the strategy here. Why you want to be buying calls and selling puts. Selling SEs when you're bearish, because the calls are going to go down in value. You're going to get a lot more calls, a lot cheaper. You'll be able to sell a lot more S&Ps. Okay, so anyway, getting back to the story. Sorry, I digress. I get excited about the strategy. So here we're scaling out. Start selling 160, 170, 180. When we're trying 190, doesn't work. So here, now we're starting to make, same thing, 40. We're making higher highs the whole way through. And by the way, if you draw a trend line here, you broke the trend line. I'll just show you what I'm talking about, just to give you a quick idea. So we're becoming aware. See, we broke the trend line. You see the big drop off here. This is a big drop off. We only go to a 40. Look, it's not even a 40 of the day. Okay, not even a 40 a day. Now, we should go back and take out the high. So you sell a little here because you're nervous. Maybe market comes down, a little retest, you want to buy them back, fine. Look at this. We can't take out the high now. This is not good. Okay? See, I'm down to tag ends, lower lows, lower highs. Okay, that's what happened. You're starting to change the direction of the day. You're not making higher highs from shallows. So you should be taking out the high if this market. But again, remember, the ADs at flat don't support the market going higher. So you have some tertiary indicators that are telling us, hey, ain't confirming the move. Meanwhile, look at this. Look at the oscillator. We're doing 44s, jam 44s. We should be going up here. We're not. We're not going up. Sign of weakness. Look, the oscillator's getting oversold in here. See, oversold. Get a little divergence, nothing. But meanwhile, I put a trend line on here. I got this breakout level. Now we have a declining wedge. Okay? Guess what? 80% of the time it's going to take out the low. So you want to short all the rallies back. And then we start failing underneath the mid-uni. The oscillator starts failing under 62. Big sign of weakness. So we want to short all rallies back to the 62. Sell it. Sell it. Sell it. Sell it. Sell it. Sell it. Now we break underneath support. This is a big buy level, a 60 buy level. You're going to get an automatic bounce. We call that window of opportunity. Whoa, window of opportunity. It rallies. Look at this. It dies. Can't even rally back through support, becomes resistance. Can't even rally back. Hedge it again. Look at this. One. You want to take this one. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If you take this one, that's 10 winning short trades in a row. And you can cover as we get oversold, leading divergence, you can cover, jams we can cover, jam we can cover, start covering, and then we know where to sell. Look at this. The market, this is a fabulous trend line. We break here. Look at this accelerate. You know, this is a nice move. This is like 3 or 4 points. You know, you're long a 50-cent option, okay? And you're making 3 points, 4 points. That's $200 on a 50-cent option. Okay? That's a lot of money to be making. Anyway, this is what I said. See trend trading, 9 winning hedge shorts right from the Bible. Mid-Juni, oscillator week, it just goes down the page. And then again now, so what you want to be doing this whole time we're in, and you keep reading my blogs, you want to be selling rallies. You want to be selling all the rallies. Until such time the market gets undervalued, and my guess is somewhere between 1275 and 1300. The market will be exceedingly cheap, and we'll look to be very, very aggressive buyers of calls and sellers of S&Ps. But what we're trying to do is survive out there. We're not trying to make bets, the market's going up or down. What we're trying to do is make money consistently with the least amount of risk, yet the biggest exposure to the upside, and that is hedging and parlaying. All right, folks, good night. See you next week. If anything exciting comes up, we'll do some more educational videos. But meanwhile, I just want you to understand multiple time frame trading. You see where the big market failed on the daily chart. We didn't make higher highs. It means we're going to take out the previous low. What are we doing? We're now taking out the previous low. And we're going to go to a level, whether it's 35 or 1300, 1335, 1300, and then we'll start back up the page again. But meanwhile, all we want to do is trade. We want to be forced to trade. If you own the options, okay, you're going to be forced to trade. You might say, gee, this is 2 points, this is 2 points, I don't want to do the trade. But when you're long the calls, 2 points is $100. You paid 10 cents for the option, 15 cents for the option. These are killer trades. This is incredible. Now, Monday, when you go out and buy the options near the money, slightly out of the money, you're paying $1. So you're going to have to do 2 to 4 trades to make your money on the first $100 purchase. When you're buying 10-cent options, you're making money on the first hedge. This is what the game is. Now, I wrote in the blog on Sunday, okay? I wrote in the blog on Sunday that it didn't matter whether you bought puts and bought the dips. But you can see how much easier it is to be long the calls and selling. So this is a much clearer sell. Much simpler sell than trying to figure out where to buy this stuff. And then if you're wrong anywhere along the line, look at this. You could have sold and went to the bathroom and stayed out for lunch. And picked up 10 points. Just go to the bathroom. Forget it. You don't have to worry. See, that's because you're erring on the side of the market. Whereas if you're long the puts, you're going to make money, but it's very hard to hedge. Now, you can go, if you say I'm long puts here and you go to the bathroom and come back, 4 hours later and you made 2-3 times your money, it doesn't matter either. I just think it's a lot easier to be long calls and selling the futures because the open-ended side is the future side. And you have to be right on the puts. Believe me, you're paying a big premium. If you're wrong and the market just dies in here, okay, guess what? Your put can expire worthless because the premium you pay. The put can expire worthless. That's what I don't like about buying. I love buying the calls because they're so cheap when the market's going down. And I get a chance to sell the shit out of them and pay for them. Every single trade pays for a trade, pays for the calls. So that's 9 times your money basically if you do this thing right. From here to here, 9 times your money on the options, on selling the calls against the puts. Selling the E's against the calls. Okay, that's what the game is all about. Have a great night. Thank you, and if there's something there, I'll be back with it. And good trading until then.